Is there a more hated sector than oil and gas right now? Probably not. Fossil fuels are a dirty word. People avoid them like they avoid talking politics at the dinner table. Environmental activists rally against them, and Western governments push for green energy. And yet, oil consumption continues to grow, and 30% of it still comes from offshore sources. Despite this massive demand, the offshore oil sector is down nearly 70 to 80% from previous highs, even after seeing some improvement. So why is everyone asleep at the wheel? Today, we're diving into one of the most hated and ignored sectors of the energy industry, offshore oil and gas, and why it could be primed for a massive comeback. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. Let's start with a reality check. Despite all the headlines and excitement around renewable energy, the world still heavily depends on oil and gas. In fact, global demand for oil has been steadily increasing, particularly in developing regions like Asia. While many argue that renewable energy is the future, oil remains the backbone of industrial economies. For now, it powers the global infrastructure that drives everything from manufacturing to transportation and even the petrochemical industries that produce the goods we rely on daily. But what's crucial to understand here is that the biggest demand for energy isn't coming from the West anymore. It's shifting to China, India, and other rapidly developing nations. These countries are home to the world's fastest growing economies, and they're consuming more energy every year as they industrialize. China, with its enormous population of over 1.4 billion people, is one of the largest oil consumers on the planet, and yet, its per capita oil consumption still lags far behind that of the United States. If China's oil use were to catch up to US levels, the resulting surge in global demand would be unprecedented. But it's not just about China. Across Asia and the broader global south, as living standards rise, so does energy consumption per capita. Millions of people are moving from rural areas to cities, purchasing cars, using more electricity, and consuming more goods. All of which, of course, require energy to produce and transport. The numbers tell a compelling story. This shift toward urbanization and industrialization in developing countries is driving up energy demand at a pace that renewables cannot keep up with in the near term. This means that, for the foreseeable future, oil will remain critical to meeting the world's growing energy needs. So, where does offshore oil fit into this picture? Despite supplying 30% of the world's oil, the offshore oil sector has been severely underinvested in recent years. Once a dominant force in the global energy landscape, it's been pushed to the sidelines, largely due to a combination of poor financial performance and a shift in capital toward more popular sectors like shale oil and renewables. This mass exodus of capital has left offshore oil at rock bottom, with many companies struggling to stay afloat as investors flee to what they perceive as more promising or eco-friendly alternatives. One of the clearest signs of this collapse is the drastic reduction in capital expenditures for exploration and production. Oil majors have consistently slashed their budgets, particularly when it comes to large, conventional projects like deep-water drilling. These projects, while more complex and costly than onshore operations, are vital to ensuring the world's long-term energy supply. Yet, due to this underinvestment, the pipeline of new discoveries has essentially dried up. To put it in perspective, the last major oil discoveries were over a decade ago, and the current pace of new field development is nowhere near fast enough to meet future global demand. What makes this situation even more concerning is that global oil demand continues to rise, especially in developing regions. Renewable energy sources just cannot replace fossil fuels on the scale required to sustain modern economies. As the offshore oil industry shrinks, we're now staring down the barrel of a supply crunch that could severely impact the global energy market. But herein lies the opportunity. The collapse of offshore oil has created an environment where supply is limited, and as demand continues to climb, prices are likely to surge. For investors willing to take the contrarian view, this is the kind of moment that precedes a potential rebound. Imagine walking into a sector where prices have been decimated, and yet the need for its services has never been greater. You're buying into oil at a 90% discount in some cases, while everyone else is piling into overvalued tech stocks. Crazy, right? Here's the contrarian thesis. Years of massive underinvestment in offshore oil have set the stage for a severe supply gap. The oil industry, particularly the offshore sector, has been suffering from neglect as companies shifted focus to other, seemingly more profitable areas like US shale or even renewables. Oil majors, once heavily invested in finding and developing new offshore fields, have slashed their exploration budgets, and we're now beginning to pay the price for this short-sightedness. What's more important to understand is that while the media and many investors focus on renewables or shale, the world still needs a steady supply of oil, and much of that comes from offshore fields. Offshore oil isn't some niche player, it's a critical component of the global energy mix. As we've discussed, the world gets about 30% of its oil from offshore sources, and with global demand rising, the supply shortage we're facing is no small issue. The decline in new oil discoveries should be setting off alarm bells for anyone paying attention to the energy markets. In the 2000s, there were several large oil discoveries, particularly in deep water fields. But fast forward to today, and those large discoveries have dwindled to almost nothing. Oil majors simply aren't investing in new exploration, and the result is a rapidly shrinking pipeline of future oil production. At the same time, existing oil fields are being depleted, which is a natural part of the life cycle of any oil field. This is where the supply gap becomes critical. Without significant new investment, global oil supply won't be able to keep pace with growing demand, especially in the developing world. And with fewer new fields coming online, prices are likely to surge. This gap between supply and demand could lead to a significant spike in oil prices, creating potential opportunities for investors who are willing to bet on the recovery of the offshore oil sector. In short, the years of underinvestment in offshore oil are now catching up to us, and the global energy markets will soon feel the squeeze. But what about US shale, you might ask? For a while, the US shale revolution seemed like the answer to the world's oil needs. It allowed the US to dramatically ramp up production, even becoming one of the top oil producers globally. But beneath the surface, shale oil has some serious structural weaknesses that make it far less sustainable than many believe. The biggest issue? Shale wells deplete much faster than conventional oil wells. Unlike traditional oil fields, which can produce oil steadily for decades, shale wells experience sharp production declines within just a few years. This means that to maintain production levels, companies have to constantly drill new wells, leading to higher operational costs and a race against depletion. This frantic pace of drilling has created another problem: financial instability. The US shale industry has long been propped up by heavy debt financing. Many shale producers rely on borrowing to fund new drilling projects, hoping that oil prices will stay high enough to make those wells profitable. But when oil prices dip, as they often do in this volatile market, these companies find themselves struggling to generate positive cash flow. In fact, even during periods of high oil prices, many shale companies have been operating at a loss, burning through cash just to keep production going. This model is unsustainable in the long term and puts the entire industry on shaky ground. Moreover, The best and most accessible shale plays have already been developed, leaving companies to target less productive, more expensive areas. This only adds to the financial strain and limits of the industry's ability to expand production. As the easy oil runs out, the costs of maintaining and growing shale production will continue to climb, making it harder for these companies to stay profitable. This is why many analysts believe that the US shale boom is beginning to wane, and its days of explosive growth may be behind us. As shale production declines, conventional offshore oil will become increasingly critical to meeting global energy demand. Offshore oil doesn't suffer from the same rapid depletion issues as shale, and the long-term productivity of offshore fields makes them essential for global energy security. For investors who can see beyond the hype surrounding shale and renewables, there's a real opportunity in the offshore oil sector, which will play a pivotal role in balancing supply and demand as shale falters. In short, shale won't save us, and the world will need to turn back to conventional oil sources, particularly offshore, to fill the growing supply gap. Now, let's talk about where the real opportunity lies: offshore oil services and equipment companies. While oil production companies tend to grab the spotlight, the companies that provide the essential tools, infrastructure, and services for offshore drilling have been massively undervalued. These companies are often the unsung heroes of the oil industry, but they'll be crucial in the sector's recovery. Think about it. Before any oil can be extracted, companies need specialized equipment, rigs, and service vessels. After years of being battered by the downturn in offshore drilling, these companies are poised for a significant rebound. Take offshore service vessels, for example. These vessels are used to transport equipment, personnel, and supplies to and from offshore rigs. During the collapse of offshore oil, many OSVs were either idled or scrapped due to the lack of demand. There's currently an oversupply of these vessels sitting idle, waiting for a resurgence in exploration. But once oil prices rise and exploration picks up again, these vessels will be critical to supporting new offshore projects. The companies that own and operate these vessels, which have been trading at rock-bottom valuations, could see a massive increase in demand and profits as activity in the sector ramps up. The same goes for companies that manufacture specialized equipment for deep water exploration. As oil majors increase their capital expenditures and start new offshore projects, companies that focus on this could see their order books filling up fast. In essence, these oil services and equipment companies are the hidden gems of the offshore oil sector. Their undervalued stock prices and essential role in any potential offshore oil recovery make them attractive investment opportunities. When exploration rebounds, and it inevitably will, these companies will be at the forefront of the comeback, providing the infrastructure that will power the next phase of offshore oil development. Savvy investors who can recognize the importance of these companies before the rest of the market catches on may stand to profit the most. Now, here's the part where it gets interesting. There's a massive geopolitical shift happening right now that could have profound effects on the global oil market. The world is slowly moving away from Western financial dominance, particularly the dominance of the US dollar as the global reserve currency. For decades, the US dollar has been the backbone of international trade, especially for commodities like oil. However, many nations, particularly those in the BRICS group, Brazil, Russia, India, China, and South Africa, are actively working to reduce their reliance on the dollar. These countries are building alternative, commodity-backed financial systems that sidestep the traditional dollar-based system, and oil is at the center of this transformation. By using oil as a key reserve asset, these nations aim to insulate themselves from the economic influence of the West. For instance, countries like Russia and China have been making deals to trade in their own currencies, bypassing the dollar altogether. In some cases, they're using gold and oil reserves to back their currencies, creating a new financial system that doesn't rely on the dollar for stability. This shift could have huge implications for global markets. For one, it could weaken the US dollar's dominance in international trade. Oil, which has historically been priced and traded in dollars, might start being traded in other currencies, reducing the dollar's influence over global trade flows. As more countries adopt this strategy, the value of commodities like oil could increase as these nations stockpile reserves to back their own currencies. In the long run, this could even lead to a more fragmented financial system with multiple regional powers controlling their own spheres of influence, particularly in terms of how oil is bought and sold. This trend is especially relevant for sanctioned countries like Russia and Iran, which have been forced to seek alternatives to the Western-dominated financial system due to economic sanctions. These nations, along with their allies, are actively creating bilateral trade agreements that avoid the US dollar. For example, Russia and China now regularly trade oil using yuan instead of dollars. These moves reduce their vulnerability to Western economic pressure and bolster the strategic importance of oil as a geopolitical asset. For investors, understanding this shift is critical. As the dollar's role in global oil markets diminishes, the value of oil as a strategic commodity will likely increase, and nations moving away from the dollar could drive up demand for oil-backed currencies. This creates yet another tailwind for oil prices, especially as these alternative financial systems continue to develop and gain traction globally. Finally, let's address the elephant in the room: ESG investing. For years, ESG investing has dominated conversations in financial markets, pushing capital away from fossil fuels and toward renewable energy under the banner of sustainability. Investors, motivated by both ethics and the potential financial upside of green energy, have increasingly funneled their money into renewables while shunning the oil and gas sector. But this shift has created a significant and potentially dangerous level of underinvestment in the fossil fuel industry, particularly in crucial sectors like offshore oil. The irony here is striking. While ESG investing has grown in popularity, the world's dependence on reliable energy sources, namely oil and gas, hasn't diminished. Indeed, with energy security becoming a bigger global concern, we're already starting to see some backlash against the ESG movement as governments and companies begin to prioritize reliable, affordable energy over long-term sustainability goals. As geopolitical tensions rise and global energy demand continues to grow, nations are being forced to confront the reality that renewables are not yet capable of replacing oil and gas at the scale required to power modern economies. Let's take transportation and petrochemicals as prime examples. These industries remain heavily reliant on fossil fuels with no immediate alternatives that can match the energy density and reliability of oil. Electric vehicles are making headway, but the infrastructure needed to fully support widespread electric vehicle adoption, such as charging networks and battery supply chains, still has a long way to go. Meanwhile, the demand for petrochemicals, which are essential in everything from plastics to pharmaceuticals, continues to rise globally, and oil is an irreplaceable feedstock in that sector. Despite the push for renewable energy, the global demand for oil has increased. This is especially true in developing economies where coal, oil, and gas remain the most accessible and affordable forms of energy. In these regions, energy security and economic growth take priority over emissions reductions, further driving up demand for fossil fuels. The reality is that while renewable energy is growing rapidly, it's not yet sufficient to displace oil, particularly in heavy industries, aviation, and global transportation networks. This creates a paradox. ESG principles are driving capital away from oil and gas, but global energy security increasingly depends on these very resources. As a result, governments may soon be forced to rethink their energy strategies, prioritizing reliable energy over sustainability, at least in the short term. We're already seeing hints of this shift as countries like Germany reopen coal plants amid the ongoing energy crisis sparked by geopolitical disruptions. This is a clear signal that energy security trumps sustainability when push comes to shove. In the end, oil and gas will remain critical to global energy security for decades to come. For investors, this presents a significant opportunity. While the market has been busy chasing renewable stocks, the underinvestment in fossil fuels means that supply shortages are likely, which could drive up prices and make the oil sector highly profitable once again. So, what's the takeaway? The offshore oil and gas sector is at a historic low, but the fundamentals suggest it's poised for a significant comeback. The world still relies heavily on oil, particularly from offshore sources, and the supply constraints caused by years of underinvestment mean that this sector could soon see a revival. The smart money will be patient, understanding that this is a long-term play. While the world focuses on renewables, those who bet on the forgotten oil services sector stand to make substantial gains when the market eventually turns. If this video and overall investment philosophy piques your interest, the algorithm has brought you to the right place. Offshore oil and gas is one of the many themes or portfolios that we've organized in the Capitalist Exploits Insider Members section. To gain access to the specific companies we're looking at, and even more in-depth rationale about offshore oil and gas and many other sectors, check out the links in the description below. The research used for this video is available in the description below, and thank you so much for watching, and remember to stay informed.